You check your credit app, you see a score of 780. That sounds like a guaranteed approval for your dream home, right? So you walk into the lender's office, confident, ready to sign. But then later you get a letter saying that you're denied. Or maybe you get approved, but the interest rate is full 1 point higher than what you originally had seen in the TV or internet. You're confused. You paid your bills on time, you did all the right things, you have a perfect FICO score. But what if I told you that the modern banking world, your FICO score is becoming obsolete? The bank doesn't look at your credit report. They look at an entirely different score. One that you may have never seen before, one that actually you cannot buy into, and the one that decides your financial fate in milliseconds. Now, this is not a glitch. It's a carefully crafted move by the lenders using artificial intelligence to predict your future behavior. And right now, that AI is betting that you are going to be at risk. In this video, I'm going to pull back the curtain on the black box of the modern underwriting system driven by AI. We're going to show you how hidden data mining strategies the bank are starting to use to deny you, and exactly how you can groom your data to beat them in their own game. Let me get this one thing clear. For decades, we have been told that if you keep up your FICO score, the credit score, high, you win the game. But FICO is just the cover charge to get into this club. It doesn't mean that the bouncer is going to buy you a drink. Bank and mortgage lenders have realized that traditional credit score are looking in as if in the rear view mirror of your car. They tell us what you did 3 years ago, which is in fact correct. They don't tell us if you're going to run out of cash next month. So the major players, from the big banks to fintech lenders, have switched into internal risk scores. This is driven by AI and machine learning. So they're ingesting data points that has nothing to do with your credit history and everything to do with your daily psychology. Let's get into it. So they're building a profile of you that is far more invasive and personal than you can ever realize. They're not just looking at the debts. They're looking at your stability, your spend velocity, your life choices, everything that you do every day. Today, we're going to break down the math behind this new system, specific triggers that kills the deal for you, and how do you flip the advantage to get the lowest possible rate. Let's look at the math for a moment. Historically, underwriting was driven 100% by humans. A person who, with a calculator, they looked at your pay stubs, they looked at your credit report. If your income is high enough and your credit was good, the math worked. Because it's A plus B equals C, you get the loan. But recently, that game has changed. Lenders have started to realize that FICO scores were missing a massive amount of defaults. They were losing money on people with good score who suddenly went broke because of bad spending habit that FICO, in fact, does not track. Enter the AI model. Companies like Zest AI or internal proprietary systems like Betters.com's Tin Man, what they do, they don't ask, did he pay the note in 2019? They ask, based on 500 different variables on you, what is the statistical probability that this person is defaulting in month 18 of that mortgage? This generates what is called internal risk score. It sits on top of your FICO score. So you could have a 780 score, which is a great score, but if the internal AI gives you a low grade, you are toxic to them. Why do they do this? Well, because banks are playing a game of averages. Research shows that AI models can predict default risk 15 to 30% better than the traditional scores. This is a massive profit to the bank because it increases their margin significantly. So if they can weed out just 1% more bad loans, they're going to save millions of dollars. And the profit machine is going to come roaring into life. So you're no longer just a borrower with a credit score. You are in fact a data set. And if the data shows volatility, the computer shuts down the approval process. So where are they getting this new data from? Well, have you noticed that when you apply for a loan, now they didn't just ask you for a PDF bank statement. They ask you to log into the bank account using services like Plaid, which we always use, or FinCity. Once you log into the bank account, it's kind of creating some efficiency for you. But what if I told you that by doing that Plaid login, you just handed the AI keys to your entire financial personality? This is called cash flow underwriting. The AI is actually scanning your transaction history for patterns that human underwriters would generally miss. They're not just checking you for if you have money for a down payment. They're analyzing your spending behaviors. They're looking at the spending velocity. Here's what triggers the internal alarm in this AI black box. So there's first trigger, which is the trigger number one. Income velocity. Are you a gig worker? Do you drive Uber on weekends? If your deposits fluctuate wildly, like from $5,000 a month to $2,000 next month, the AI hates that. Stability is the name of the game. Even if you make really good money, high variances creates low internal score because the algorithm predicts that you won't survive an economic downturn. Trigger number two, residual income strain. The AI looks at your free cash flow after all the expenses have been paid off. So you might have a low debt to income ratio on paper because you don't have any credit card. But if you spend a $2,000 a month on dining out or hobbies or streaming services and buy now and pay later apps that don't report into credit bureaus, the AI actually can find that from your information. It calculates that you have zero margin for error. Trigger number three, which is actually the silent killer, overdrafts. Now, in old days, if you overdrafted your checking account, your mortgage lender might not notice that it wasn't a specific month statement because they have to go and find and hunt it. Now, the AI scans 12 to 24 months of data instantaneously. One or two overdrafts suggest that you cannot manage consistent cash flow. To the algorithm, that signals a default behavior. They're building the psychology of the profile on how you can handle money when no one is watching. Now let's talk about when your loan officer runs your file using this automated technology and underwriting system, which is called as automated underwriting system, AUS. Typically, you want to see an approve eligible. That's the status that you're looking for. That means your computer likes you. The deal is easy and you're going to get your loan. But sometimes, despite the good credit, you get refer or eligible. That is another status that you don't want to see because refer is inside lingo. The computer doesn't like the risk that this particular person has. So the human needs to take a deeper look into their file. Now, in the modern era, a refer is often a soft denial. Many lenders simply won't touch the file that doesn't get automated approval because it's very risky for them to sell it to the investor in the secondary market, which happens a lot with your mortgages when they consistently sell it. This is when the internal score kills the deal. The system might see that you have a 740 score, which is really good, but you have what they call a layered risk. Maybe you're putting down a low down payment, which is the risk number one. The AI actually detects that you recently opened your credit card, a new credit card, risk number two, and your rental history, which is now being consistently tracked across all the bureaus, shows that the late payment was done 2 years ago. That's risk number three. Individually, none of these are deal breakers. But if AI combines them and says the probability of the default is 42%, if the bank cutoff is 40%, you're out. It's a high-stake chess match that we're playing now, and the AI is calculating the moves that you don't even know that you were making. How do you actually flip this to your advantage so then you can be back in the game? Now, if you're planning to buy a home in the next 6 to 12 months, you need to groom your data. You have to realize that you are being watched, not just by the credit bureaus, but also by these banking AI algorithms. So here's a strategy to win the game. Strategy number one, the digital detox. Stop using your primary transaction accounts for discretionary chaos. Like if you use Plaid to connect your bank account, you want that account to look boring. Consistent deposits coming in, consistently making bill payments, minimum random outflow. Use a separate account or a credit card account for day-to-day coffee dining and pay off that amount in full. Keep the main vein clean. That's the number one. Strategy number two, artificial stability. If you are self-employed or have variable income, which a lot of self-employed people do, try to pay yourself a consistent salary into your main account rather than random lump sum transfers. You want to mimic the stability of the W-2 employee. The AI loves that predictability. Strategy number three, pad the reserves. What do I mean by that? The banks used to just want to see the down payment. Now the internal score want to see that after you paid the down payment, you still have 6 months of cash flow left over to take care of your expenses, because it signals to the model that you are not living on the edge. So the next time you see a mortgage ad promising an easy approval, you have to see for it what truly it is. It's a funnel into a sophisticated data mining operation. Don't let the algorithm define you. Understand the rules, clean up your data, and beat them in their own game. Now, to learn about how to optimize your credit score and how do you look at the profile, unlock the interest rate, you can watch the next video that is showing up on the screen and become an expert using credit.